Welcome, ladies and gentlemen, to realestateinvestormba.com. At Real Estate Investor MBA, we strive to provide valuable information from various experts within the business and real estate community, covering real-time market and economic information as well as curriculum-level material within various real estate investing niches. We aim to be relevant, straightforward, and forthcoming with actionable information for our community. And here's your hosts, Tejas Gosai and Jeremy Moyer. Hello, ladies and gentlemen. Welcome back to your favorite podcast in the world, Real Estate Investor MBA.com. And Jeremy Moyer, my partner over here, has done a wonderful job. He helps with the guests, gets everything cooking. So, Jeremy, I can now announce that we are on iTunes, Spotify, Stitcher, iHeartRadio, TuneIn, and Google Podcasts.
There you go.
We also are on Facebook, LinkedIn, Instagram, and just thank you to everyone that has been following. We love talking to entrepreneurs, real estate investors, people that know what's going on, and pride ourselves on the information. So thank you. And with that, Jeremy, let's get it to the guests.
Absolutely. Today we're very excited. We have Scott Choppin with us today. Scott is the CEO and founder of the Urban Pacific Group. So the company was founded in 2000 to pursue urban infill real estate development. So Urban Pacific is exclusively focused on the innovative urban townhouse rental housing model, which was created by Urban Pacific. The urban townhouse is a new construction housing model that pairs private capital with multi-generational workforce housing, rental housing. So the Choppin family has been in real estate development business since 1960, including the development of the World Trade Center in their hometown of the Long Beach, California. And Scott entered the business in 1983, working on multifamily development projects. So Scott, thank you so much for your time this afternoon and joining us for an interview.
Great to be here, guys. Appreciate the invite.
Absolutely. Let's just start off by telling the listeners a little bit more about yourself. I know that intro said that it was like family business when you were brought up, but kind of tell us how exactly you got started, and then more how you got started with the multi-generational housing. I know you and I, we talked a couple of weeks ago, probably for over an hour, and it was very interesting. So let's get at it.
Yeah. Like the intro said, family background in the real estate development business. When I first got out of high school, I didn't have any, specific ambition to go into real estate development. In fact, as kids do when they're that age, sort of want to do, whatever your parents, didn't want you to do, or do the opposite maybe. And I actually worked in the trades for a couple of years. So I worked as an electrician out on job sites, from time I was, 17 to about 19 years old. And, that taught me a few things. One is it taught me I didn't want to do that as a long-term career choice. Like, it's clearly, this is not a sustainable model for various reasons. One, you could sort of figure out you're going to have limited wealth generation capacity. People, their bodies wore out, eventually. And so that sort of informed me what not to, but although it did teach me a lot about construction. So how to build apartment buildings. In fact, all the work I did was on new construction apartment projects. And then at about the age of 19, a couple things happened to me, late 18, 19 years old. One is I was on one of these job sites and the developer pulled up. And I knew who the developer was because I had this background, right? Like, and, he's driving the nice car, wearing the suit and tie, in those days. I mean, you guys are both wearing ties, but, like we used to more. And I go, oh, I want to be that dude. Like I finally go, oh, light bulb went on and, this is what I want to do. And also I read a couple books. I read a lot and I always have. And it was, sort of a number of books, but, they were sort of in that genre of, invest on real estate in the weekends and make $1 million, right? Some of those old 50s era books. And that really enlightened me to deal making, right? So although I had a family background in real estate development, I didn't understand the deal making side. Of course, I knew, you find land, you build a building, you rent it out, right? That was like sort of in my background, but the idea of, being an entrepreneur in real estate and what you do to produce value and profitability was, sort of a missing element for me. And I read this book and I was like, oh, all right, I got it. And really from about that, time at, 18 years, 19 years old, I mapped out really what was the rest of my career, which was, get a college degree, go work for others in the professional real estate development domain. In fact, I did all those things. And then, fast forward to
work for free, right?
Say again.
Work for free sometimes, right?
I do recommend that. In fact, I wrote an article, if people want to look on our LinkedIn profile, 6 ways to build your real estate development career. And one of them is get an internship and do it for free, right? It will be so worth it. In fact, I have people that I have interned with us that are now actually developing into their professional real estate development careers. In fact, one guy called me and he's like, dude, I didn't know how much that internship for free was worth, but now that I am in the professional, he got like a full scale project management job at a real estate developer. And I think, he and I talked about it, like if he didn't have that background that we built for him, he was with us for about a year. He wouldn't have been able to sit down with those folks and get that job. And he was, it was nice enough to come back and tell me about that. I don't think at the time when he finished in his internship, he recognized it, but that's all good. He's happy. He's a happy dude now. So, but I went into the professional business, working specifically for a subsidiary of a company called Kaufman and Broad at the time, which is now KB Home, big, home building company, but our division built and syndicated apartment buildings, new construction. And so that gave me, I was there for about 4 years, and that gave me the most insane education. Like I wanted that job when I was, finishing college, but I didn't know how good that job would be. And it really set me on really the rest of my career arc. So I learned how to be a real estate developer at that job.
It's awesome. Thanks for sharing all of that. I'm going to ask the first question. So, mindset. I mean, I love asking the first question about mindset and, how you built that or build into that or maintain it. Like, do you have kids?
I do. Yeah.
Okay.
3.
I think that's like I have 2. Jeremy has a few.
Mm-hmm.
I think that's a big piece of like how you can stay motivated in the game, things like that. But can you share some of your kind of tricks, how you stay headstrong in the real estate business with how much deal making and cutthroat, concepts there are out there?
Yeah. Great question. I appreciate that. And you're exactly right. Like I say at home and with my family and my wife, my marriage and my kids are the best thing I've ever done in my life, right? Hands down. I have 3 kids, 19, 16, and 13. And that's what I work for, right? And when I started my career, I was at 32 when I formed Urban Pacific. I'm 53 this year. I was after making my building my identity in the marketplace, being known as a competent developer, making money, of course. But over the last about 10 years, maybe 8 to 10 years, really, it's very much solidified my existential purpose. What I work for fundamentally is for my family, right? For our family now, to produce a good life now, to take care of my family and their future, right? My wife and their future. And then the other place that I go is working with powerful networks. And now, of course, like people will think of networks in the sense of, networking, but what I really mean is working with people, vendors, partners, capital partners, lenders, JV partners, anybody who's around me, that I constitute them, like I build that network and constitute them to be high performers themselves, and also surround myself with people that are, looking to build their careers and work with me to help me build my career and my business, and that everybody's expectation is to operate at a high level. And in fact, part of that is to keep everybody, accountable to each other, both in, business transactional, structures, but learning structures like I do. I'm all about, continuous competitive learning practices and networks. And, a big part of my learning networks now are people that I study with, and we have weekly calls. I mean, you might think of it like in the context of a mastermind. But we don't call it that. But it's really working in the context of people who all study business and strategy at a higher level, and who we work together to keep each other accountable, to help each other, for us to all produce our own good lives in whatever ambition that we have, financial ambitions around taking care of our families, how that looks.
That's awesome. No, that's great. It's, sometimes we feel alone, when we're in business in certain projects, and those groups are great. I'm a part of a few as well. And it's great to bounce ideas off of each other or just get different perspectives.
Yeah.
On how to solve problems. So that's awesome.
You really need it, because I think one of the things I'll share is, everybody has cognitive blind spots, right? Like just things you don't know that you don't know, right? And in business, that's particularly like a weak spot for entrepreneurs, because all entrepreneurs are optimistic by nature. We're self-selected optimists, right? If we weren't, we wouldn't launch our own endeavors. But part of that is to be around people that will reflect on, what their blind spots are, and also go, dude, I see this happening with you, or I see, watch out for this, or, hey, you should think about this, or you should do that. Not in the context of, forcing somebody, but just to open up space as a possibility and thinking together, right? Thinking and thought and action together, right? And, two is always better than one, right? No lone rangers. And although we live in the United States, where the idea of the maverick, business person, I did it all on my own, is culturally a common narrative. It's not really true, right? Like if you look at, I don't know, pick anybody. In fact, the guy I study with predominantly, it's a group called the Aji Network. Toby Hecht is the founder, and Toby always has this great way of saying it, is hey, when Jack Welch operated GE, he had a network of help of 300,000 people, right? That was the employee base of GE. And really, when you think of it, he sat at the pinnacle of 300,000 people. And we all know GE had this rigorous, hiring practices, set of practices, and they would drop the bottom 20% of performers or whatever the number was. But if you think about it, anybody, whether they're small company, mid-size, or big, right? If you think about your own employees, your teams, but also networks of transaction learning, that really to be oriented around being help to others, and they be helped powerfully back to you. That's the most important thing that I've learned in the last 8 or 10 years of studying business at a fundamental strategic level. And then it's then you're all about picking and selecting and upgrading your network constantly. So you're ever improving. And sometimes it's hard, right? Sometimes you got to tell somebody, hey, look, I love you, but I can't work with you. Sorry, it's hard. It's a little harsh, but if I don't do that, in fact, this is back to this idea of family. Where I go with it, guys, look, if I don't make this move, if I don't upgrade my network and change to a better performer and be a better performer myself, I hurt my family. And I don't do that. Right?
That is a good way to look at it.
Yeah.
No, that's
appreciate that.
All good points. So, Scott, I want to kind of go into a little bit more about what you're doing right now. Can you, for those that are listening that are not familiar with workforce housing, can you kind of tell everyone what that housing model looks like? Why did you pick that niche specifically? And how does I know your model from our previous conversation is a little different from maybe some other workforce housing models. Can you kind of give us a sneak peek on what that looks like?
Sure. Yeah. Our model, our workforce housing model, is called the UTH, or urban townhouse. That's the name we've given it. And in workforce housing, just first as a definition, has many different definitions, right? If you ask one person, their definitions would be different than ours. So I'll define it. Basically, we build a new construction townhouse style rental unit that has 5 bedrooms, 4 bathrooms, 3-story townhouse. So it lives like a house, right? Like you live above and below your family. One of those bedrooms and bathrooms is in the ground floor, making it multi-generational. 2-car direct access garage. So it really is like a townhouse condo. Maybe people might think of it commonly. but we build it to rent, right? So we're a build to rent model, but we're at a low or middle density, right? Versus your standard podium product and whatever major urban metro, 4 or 5 or more stories over parking structure. That would be like the more common new construction model in this era, right? And workforce housing for us is we're literally building for families, right? 5-bedroom, 4-bath, sort of informs that like we're looking to house multi-generational families that have several members, could be mom and dad, adult children, maybe kids of the parents or kids of the adult kids, grandparents, in-laws, right? One of the reasons we do this ground floor bedroom bathroom is for grandparents that might have mobility issues. But we're really looking to serve a multi-generational working class family. Right now we're active in Southern California at an affordable rate. And affordable, like that is another definition, but you could think of the incomes for our families are generally between 80 to 120% of median income. That would be either for LA or Orange counties or any metro area that we would build in the future. That would be the income demographic. And really importantly for these families, one, they already live this way. So they already live multi-generationally, and they already live what I call an economic sharing lifestyle. So they're sharing incomes and expenses across the family group. You could maybe think of it as a form of co-living, except these are all related, a single family group, right, living together. Commonly we'll have, when we have these families come to us, they may be living in maybe a couple of different apartments, right? Maybe they're, side by side. Maybe they're, one part of the family lives in this unit and the block down, the other part of the family lives, but they already work as a cohesive economic unit, and they have multiple earners. And this is really the sort of the secret, insight into these working class families is that they do have multiple earners. Generally, they're blue collar, service industry. Obviously, in this era of coronavirus, these are families that are, probably the most hardest hit. But what you find amongst these families is because they have this economic sharing lifestyle, it really does 2 things for them. One is it has them afford more housing for the family, given all their multiple earners, right? Like if you were a single earner and you made X dollars and you had to pay for 1 bedroom that was, $2,000 a month, well, you're going to have a limit to what you can afford. In fact, the statistics in the newspaper, it's like, hey, somebody's going to make $37 an hour working full time to afford the average size unit in Southern California. And I'm making that number up, but you get the point. But when you start to get 3 or 4 or 5 income earners together in a family, any one of them may be making 20, 30, 40, 50,000 a year, right? Which by themselves wouldn't afford a new unit like in the marketplace. All of a sudden they're combining together and they're 120,000, 150,000, right? And so that then basically puts the housing costs at 30% of their income at a bigger number, which means they can afford better housing. Now, all we do is give them a unit that now serves their family from a lifestyle standpoint. They can all live in one unit. They got the 2-car garage. They got the in-unit laundry. And so this is sort of the unique characteristic of UTH that serves these, these middle-income families, most coherently. And by the way, it's probably the most undersupplied marketplace in America is middle income working families. They make too much to afford true affordable housing, right? Like government subsidized. They don't want to, occupy the studio unit in the high rise in downtown LA, right? That doesn't serve their family, and plus it's too expensive. And so we're basically serving a part of the population that's been pretty much ignored by the development marketplace generally.
That's awesome. When you told me this the first time we talked, I thought it was very ingenious because in my mind, this is kind of the flip side of single family investment housing and multifamily investment housing from the investor standpoint. Usually multifamily investments are more attractive because if one unit goes vacant, it could also be flip side look like, well, what if one income earner lost their job? In your model, there's multiple income earners, spread the risk.
Also one factor to add real quick is, they do well during up markets because they have more income to pay for housing, but also makes them resilient during a recession because, again, multiple earners means if one person becomes unemployed or underemployed, the family doesn't have a breakdown. In fact, the poverty rates amongst multi-generational households are much lower than single and dual income families. And this is, we don't necessarily serve, low income families per se, although of course, if there's a fit, there's a story, we'll do that. But really what ends up happening is these families are sort of dragged down economically because they have to pay a lot of their income towards housing. We resolve that issue for them. And particularly during a recession, as an investor, as the owner, sponsor, that's a good story for resilience during, right now, right in the middle of the coronavirus era.
I wanted to ask like a two-part question here. One, it just seems like this is a math equation, and then it's a location equation, and you probably have figured out both of them. And where the second part of it is, where are those places that you're finding these project or finding the ability for these projects? Because I'm a big hotel guy. I built a bunch of hotels in my life, and I think of a feasibility study, and I'm assuming that people don't do a feasibility study for what you're doing. It's a different metric.
Yeah, when you say feasibility study, you mean like, hey, we're thinking about this product and this location. Tell me if it's feasible generally. So we don't do that in the way that you mean. I mean, we have done it, in the past, but really, we're, as a developer, we're doing feasibility studies in-house. And particularly, we're sticking with what we know, which is residential income producing rental housing, right? We just happen to be doing a different form of that, but it's still basically an apartment community, a multifamily, income producing property. But actually, your first question is actually very intuitive, because really there's several things that make this product feasible and to produce market superior returns to investors. Because we really have two missions. One, we need to serve our investors by producing, sustainable, resilient, market superior yields to their equity. And we need to serve the tenants appropriately, like, attainably housed, meaning they don't pay too much of their income towards it. And so we bridge those two, and they're not normally bridged, by the way, right? Like those are usually the opposite, right? You go, oh, if it's affordable, it doesn't make money. And if it makes money, it can't be affordable.
Right.
And there's several things, and I'll sort of list them in no particular order. So one, we're going to pick land in locations that's more affordable and easier to build on. So think of like B and C working class neighborhoods where land is going to be less competed for. It's also going to be less sensitive to building new housing, right? Like if you go into a high or middle income neighborhood, the neighbors are going to, they're going to not want your project there. At least in California, we have that big issue. And I think that's common in many big cities, but California is the mecca for difficult entitlement, development, approval processes, like most difficult in the United States, I'd say. So, we can buy it more affordably. We can get it ready quicker because we don't have to rezone it, but also it's coherent. The people who live in these units already live in these neighborhoods. These are working class neighborhoods, like already. I mean, we didn't do anything to change them. We just went into that neighborhood and found the project. But commonly, when we open up a new project to lease up, I would say most of the families that come visit us are from the local area, maybe 10 to 15 minutes away. And there's a reason for that. One is that, they have very strong social networks. So their kids are in school locally, churches down the road, extended families in, whatever city we're in. Their jobs are generally close by. These families aren't big commuters, right? They don't drive an hour each direction to work. They're generally 10 to 20 minutes range from where they live to where they work. And there's several reasons behind that. So first is the land, right? We talked about. Then the unit type is really important, right? We build this 3-story product. It's a big unit. But if you think about how we format it, you have mostly bedrooms and bathrooms, right? Now, bathrooms are, and kitchens are the most costly part of a residential unit to build, as you guys, well know. I think that's, pretty known in the marketplace. But we have a lot of bedroom space that actually happens to be your most efficient, cost-effective space to build, right? And so I'm on the executive committee board of directors for USC Less Center, and Richard Green is the executive director. He and I met a couple of years ago, and he had a great observation. He goes, "You're not doing more density in units, you're doing density in bedrooms, right? You have a lot of bedrooms on a given piece of ground, and normally that would convert into units. Like, oh, I've got 20 units and 20 bedrooms if you do 1 bedrooms, but we're doing 5 units." right? And in 5 bedrooms, or 4 units and 5 bedrooms to get to the 20, which means that each unit, we only build 1 kitchen. And yes, we have 4 bathrooms, and that's a key part of our, competitive, capabilities to serve tenants. But what I say is that we're at the equilibrium point between building the most cost-effective space with generating the most income appropriate for the family income demographic, of course. But we're at that crossover point where we're producing maximum income for lowest cost. If you went up 1 more story and did a 4-story product, costs go up and maybe generate a little bit more income. If you go less dense, say you did a single family house, you'd build a cheaper building, but then you can't produce as much revenue. Right. And then there's extremes. Like if you went high rise, right, you produce, huge incomes on a per square foot basis, but you pay a lot of money to build that high rise. And then if you went to your single family, square house, in a subdivision, that's your cheapest space, but you couldn't, again, rent it for the maximal amount of money that because development's all about maximum income generation given your cost structure, right? Whatever we do to increase revenue and decrease costs and operating expenses is going to benefit the bottom line to the deal. Now, of course, we still have to hold what makes the rents attainable to our families. We don't want to, we can't, move away from that. But it happens to be, at least at this time in the, this time in this place, this formula works. And, we don't assess that it will work forever. But at least in California, and this is a product that, was generated and innovated from the California marketplace, where we have high housing costs and flat middle incomes. That's the real key. And the gap between those is where our housing serves.
That makes a lot of sense. It's that sweet spot in between 2 opposing factors, right? That you identify that you're targeting. That's great. Do you mind going through like a specific deal that you guys are either
Sure.
in the middle of, or that you just done, from the beginning, like how you found it, how did you find the land, what did the zoning did look like, that entitlement process? You said California's not very friendly. How much did you buy for it? What did it, just some of the figures, just to kind of give a
sure.
idea.
In fact, I'll talk about a project that we're like right in the middle of right now. In fact, we're in the midst of raising capital for it on a crowdfunding platform called Small Change. It's 1491 Atlantic. And so this is, we only do UTH. In fact, we don't do any other product type. We're such firm believers in the product and believe in the undersupply story and serving these families. We're all in, right? All in on this product type, on this business plan. So, up to about January of this year, we really were tapering our business plan down, right? Like construction costs were high. Land costs, in a peak market always go high, and, land sellers are always trying to push the limit we just couldn't find enough deals to make sense. I mean, we had a deal here or there that we could find appropriately priced, but we were like just finding less and less deals. And you just, when that happens, you just do less deals, right? And maybe eventually you might do no deals if the market, goes against you enough. But, February, March came, coronavirus hit, we're in California, we got locked down in March. And so through March and April, we were really in a story like, look, we're now in this recession. Like obviously the pandemic hit first and the recession came, immediately thereafter. But that's when we started to travel in the story of this recession resilient family. We always anticipated that these families would batten down the hatches, combine together in larger family groups or roommates, if that's what they do. And then that was actually Pew Research did a study in 2007 to 2009. 49 million households moved in multi-generationally in that era as a function of the recession, right? Meaning families joined together. That's 49 million households, which, you could argue that's, 75 to 100 million people, depending on the family size. So we knew to anticipate that would be the case. And that, in fact, turned out to be true. So a couple things happened. Land prices we anticipated would drop, which that started to happen. And also some sellers on the land side would capitulate, right? They just go, oh, I gotta move this thing, man. The market's going against me. I got to drop my price. I got to get more, realistic on my terms. So we've actually picked up several new deals. And in fact, we're busier now than we were in January, because we see we're doing good on leasing, with these families combining together, good lease rates, good velocity on absorption, that kind of thing. So 1491 Atlantic was actually the first of a series of these mid-sized projects in close to home, nimble, in our backyard, right? If we were going to do deals in a recessionary environment, knowing that these, we could still rent units, right? We could still build them for the costs that we had projected. Then we started to be in a story. Let's be really close to home, right? We can be very active, very hands-on, not try to go out of market, that kind of thing. So 1491 Atlantic is a pretty small site. I want to say it's literally 6,000 square feet. Maybe it's bigger than that. And we ended up fitting 5 UTH units in there, which is actually 4 of the townhouse units. And then we're going to do what's called an accessory dwelling unit, or ADU, which will basically create a small 400 square foot space in one of the garages in this new construction project that we can convert under California law into a studio unit, right? Which is a new law. I mean, it's several years old in California, but the ability to do this in multifamily is new. We bought the land for $365,000. In fact, we're still in escrow. So one of the things that changed when we saw that the seller market started to capitulate, we negotiated for land price reduction. That's the first thing we did. But we also started to ask for much longer timelines on the escrows. So we're in several projects now where we have several months of time in the escrow period. We'll put up land deposits and probably pass that through non-refundable. But we're really insisting that we're getting anywhere between 6 to 12 months of time to close the land. And really with the idea of get everything you can done, fully plan, check, permit ready, get the loan ready, raise the capital, and then just to put us in a patient position. I mean, we've always done that, but we're now being even more aggressive, right? Let's just not be, obligated to close quickly. In fact, that's part of the capitulation in the land market is, sellers in a peak market go, dude, close in 10 days, close in 30 days, close in 20 days. And in a peak market, they would get that.
Right.
Now that's not happening. And particularly if, again, we're in these B and C neighborhoods, right? Even less so, right? If you went to really high end neighborhood, you probably would still get sellers that are, holding on to their price. My joke is, land sellers are always get the last to get the news that the market turned down, right? They'll hold on to that price for dear life. Right. And it's hard to be a seller. We've been a seller multiple times of land assets, and, you own that asset already. You want to sell it. You got to try to get your price. Me as a buyer, or our company as a buyer, I can say no to a site. I go, no, doesn't work. Timing doesn't work. Price doesn't work. Next. Right. So it's much more fluid to be able to move through, projects that way. So we'll do 5 units. We're in plan check, with the 5-bedroom units. I think we're underwriting right now about $3,500 a month for the 5-bedroom, 4-bath townhouse unit. In this project, we're doing the studio. We also have a 2-bedroom unit, which is going to be a 3-story townhouse, 2-bedroom, and that will actually be our affordable housing unit. So in California, if you can't quite meet the zoning code, we never want to do heavy lift entitlements like rezone and general plan amendments and big, discretionary planning commission, city council based. So sometimes if our project won't quite fit the zoning code under California law, we can ask for relief from the zoning standard by what's called an affordable housing incentive, which we say, hey, we're going to give you a unit at very low income restriction, rent and incomes. And for that, you give us better parking standard, you give us smaller setbacks, lot coverage, whatever it is that you need, those kind of things. So we're actually using that as a tool pretty regularly these days, because not every site and not every zone will fit our model. And so we want to build our model, and it makes sense for us to trade that affordable housing unit to get the better setback or the better parking, particularly 5-bedroom, 4-bath on parking. A lot of cities will go, hey, 5-bedroom, I need, 4 full parking spaces inside of a garage, enclosed, covered. We've got cities that have the standard. So we can invoke the affordable housing parking standard, which is 2 per unit, which we already do in this 2-car garage that we built, plus half a space for guests. And that's pretty typical for our project layouts. So we talked about rents. What else? So, I think at the end of the day, so we're raising capital right now, small change. I think roughly over a 10-year hold, which is what we're raising capital for, we should look for about an 18% internal rate of return over that 10-year period. It will cash flow during the life cycle of the build of the the hold period. We pay quarterly. And actually small change. I work with Eve Picker, who's the CEO there. And this is our first crowd-funded deal where we're doing a side-by-side Reg CF side-by-side with a 506C. So we can accept both non-accredited, Reg CF style investors, and then, 506C is your standard accredited structure. So we're really after trying to do more crowdfunding. In fact, we've been working on crowdfunding for several years, but never quite fit with all the mainstream crowdfunding platforms. And they're all good folks, but the idea of a social impact, family serving housing product in B and C neighborhoods just didn't fit. All the mainstream crowdfunding platforms, they just didn't get us. They didn't get the product. They were like, great, but hey, we like value add. You got some of that? And we go, no, we don't want to. We don't want to be that. We want to be differentiated, like on purpose, and that just wasn't a fit. So Eve is very entrepreneurial. She has a development background herself, so she understood it immediately. And then Small Change has a social impact index that they apply to all their, capital raise offers on their platform, and we fit that nicely. We're urban infill, we're transit oriented, we're serving middle income families, those kind of things. So that's good. So.
That's awesome. No, that's great. That gives a good picture in your head of what. So do all your projects roughly, you try to produce the same return profile?
We're actually, if anything, we're normally above that. For various reasons, Atlantic, it's land price and build costs and, those kind of things, gets us into that 17, 18 range. If we merchant build, meaning if we build it, rent it, and sell it immediately, then the IRRs will be, much higher, but, 25+% IRR. So we've got a couple of deals. In fact, I'll have another deal on 1115 East Artesia up on the Small Change platform in the next few weeks. And that's about a 3-year deal. Where we'll build it, rent it, and sell it. And I think we're well above 25. I'll just say we're doing 25 plus. It would be the IRR for investor equity on that deal. But of course, the timeline is shorter, so the IRR is going to be higher. Yes, but at least in our research, particularly if you think about the resilience of this model, right? We're not distress prone. 1 and 2 bedroom product. We're not competing with 1 bedrooms in downtown LA where new construction's dropping their rents to compete. They're losing renters. We're really the product where when renters move out of that 1 bedroom, they move into our unit with other people, right? Roommates or family. So we're sort of the receiver of, people moving out of other people's projects. We're capturing those people as they come out, because you think about it, fundamentally biological need, people need shelter, right? I mean, as I say that, people go, of course. But if you think about it, that means somebody, when they move out of someplace, they go someplace else, right? It sounds patently obvious. Maybe they move home with their parents. Maybe they move in with roommates. But they're going somewhere. That 49 million household move I talked about, that's what that is, right? That's people recombining is the terminology. It's a medical term, but it's, combining together in a family group to then, forward. In fact, we're talking to, we're in lease up on our project in Orange County and Fullerton. And, one of the folks we talked to, one of the family groups was a mom with her kids that they lived in one house. The dad and the mom are getting married, they're newly married or will be. And the dad has kids in another house, and they're going to come out of those 2 houses to live in our unit potentially. So, that's a different recombination story. They're not distressed from an employment standpoint, but they see the logic of trying to, live more efficiently. And particularly if it's a brand new unit, think about it. These families, these middle income families normally never have any new housing as a choice, right? In fact, in Fullerton, we did the math. It's been like 40 years since any new housing was built in the neighborhood where we're building new. So we're the first new units to be produced in that neighborhood in 40 years. I mean, think about that, right? So if you're a family that goes, I live here because it's affordable. My kids go to school down the road, but I happen to want to, size up because my family grew, or kids are moving home, or grandparents moved in-laws. You really don't have any choice. And I don't wish that for people. I would wish that they could have all the choices they could. But when you look at it from a, realities operations standpoint, if there's new housing, then they don't do new housing.
Right.
Just doesn't exist, right? So we're giving them something that they didn't have before.
No, that's tremendous. No, I love what you guys are doing. So raising the capital side since COVID, I always like to ask this question. Just do investors kind of get the like what you're doing? What you're doing kind of is like, I want to say perfect for the environment that we're in right now, because what you just said, but do they understand that? Are you presenting deals differently, or when you talk to investors capital, are you presenting differently? Do you have to, what does that look like?
Yeah, so it is a little bit different. So it's counterintuitive, right? Like when the pandemic first hit, the story I was traveling and I go, oh, there's a, investors will be in a new story about what their investment choices will look like over the next 6 months to 3 years, right?
Yep.
And most sophisticated investors in a recessionary environment would start immediately to be looking for distressed assets.
Yep.
Right. If you look at all the big names on YouTube, think like Ken McElroy, he's the guy who's associated with Robert Kiyosaki, any of the big, YouTube real estate, sort of investor syndicator, starting to talk about. So we're like, okay, we have to be in a new narrative. Now, for us, it wasn't a new narrative. It was just our second narrative. So before I talked about that these families could afford attainable housing, new housing in a peak market because they had multiple earners and can afford the housing, right? That's a peak market story. Then you go, we're now in a recession. So people will look to save costs, right? If they're a renter and they're going to move in with more people, more roommates, recombine with family, right? And so what the difference is, we have to create a new narrative or start to put forward the second narrative, which is this is recession resilient housing. We're the receiver of benefit in the downturn because our families have multiple earners. They have strong social networks, are going to stick around. Their jobs are close by. And so the idea that we convey to investors that this is a very stable family demographic, right? They're sticky, social networks are strong. They're not moving away versus if you had your Gen Z or millennial who's just maybe they moved to LA, it's their first job. They lived in Dallas, but they moved to LA to get their job. Well, as soon as they lose their job, they no longer have the one income that was supporting that housing. So they're going to move out. Or right now they're going to stay there because eviction moratoriums are in place. But realistically, on a long-term basis, they're going to move somewhere else. Either going to move in with roommates or they're going to move back home or whatever. Again, back to the story where receivers a benefit for that move, at least those people that will decide to stay in California. And I don't say there's anything wrong with that young person who's going to be mobile. They are mobile. They're young. That's their life cycle where they're at. They don't have kids. Their extended family may be at home where they moved from. They have nothing to tie them, and that's perfectly logical. We just say we don't want to rent to them, right? We want to rent to these families that are already here, that naturally batten down the hatches in a recession. They already economic share. They already live multi-generationally. We didn't create any of that, by the way. That's just we're delivering a product to a market that already existed. Just nobody recognized it, or few people did, we should say. So that's the story we tell to investors. We go, we're recession resilient, not recession prone, right? Everybody's going to be looking for distressed assets, which is, again, perfectly appropriate. But we start to travel in the story with investors like that property was distressed for a reason, right? And what is that reason? You're going to think hard about that, right? Is it have all one bedrooms in Chattanooga, and that happens to be a hard hit employment center, and those single earner households had to move out, right? And then what made it prone before is going to continue to make it recession prone now. Now, if you can be a savvy investor and buy it at enough of a discount, then you can protect against that. But ultimately, you can't change that one bedroom mix.
Right.
You're like, you live with that. And then us as a developer, we can create our own plan that meets the market needs right then and right there, which we, firm believers in this, multi-earner, multi-generational household. So that's the story we're in right now. We're trying to compare and contrast between, hey, you could invest in distressed assets and which are distress prone, or you can look at our product, which is just, recession resilient and, the opposite of, distress prone or recession prone. And then we start to talk about the long-term sustainability and stability of the model, right? And that's where it gets us into a undersupply story, right? Which in California, we've been undersupplied for decades, right? No change there. And in as bad as the recession will get in California, locally, we'll still be undersupplied, and we'll be undersupplied for decades in the future, right? So if you're serving a family housing type that was already undersupplied, that's just going to continue. Yes, will there be adjustments in the marketplace for employment? Will rents adjust to some degree? Absolutely. So, we have several things that, are the resilience part of it. In fact, there's a book called Anti-Fragile. It's written by a guy named Nassim Taleb. And his idea of anti-fragile is a business or some structure that actually accelerates from harm, right? When things are bad, this thing gets better, right? Like, when you build, when you work out and, lift weights, you damage your muscle and then it grows from that damage. That's, right. That's anti-fragile. And that's how we see the UTH model, right? And so, in fact, that's why we've converted, other than a couple projects, which we'll sell, predominantly everything is long-term hold, because we, so firmly believe in the long-term undersupply story and the long-term stability of this tenant base, the sticky, socially strong network family groups, that we want to own this product really in perpetuity.
No, that's awesome. Thanks for that explanation. That makes a lot of sense. So Scott, in closing, how can our listeners learn more about what you're doing, follow you on social media? I know you post a lot on LinkedIn, which I find very informative. And I'll get in touch with you if they're interested in talking more.
So I would encourage people, go to our website, www.urbanpacific.com, and do a couple things when you're there. So there's a red sign up button, get on our email list. We put out a e-blast every Saturday, and we're really focused on delivering value and knowledge to investors, right? Market updates, market trends, all the economic tracking tools that we use internally. We share those out. Like, you'll see that, just like a steady drumbeat of, how we're seeing the market, new trends, because we're like everybody else. We're vigilant. We want to be, looking for the best sources of economic information, like trusted, economic sources with no agenda. So get on our email list, and then go to our contact page and send me an email. So my email is Choppin, CHOPPIN, at urbanpacific.com. Tell them you heard us on your guys' podcast. And then we'll, if people email me directly, we'll send them out an ebook that we published called How to Survive and Thrive in a Recession, which is, I think, timely given where we're at in this part of the economic cycle. But we would be happy to, send that out, send us an email, and we'll send that out to folks. And then, go on the website, and we have an investor education section, which just has tons and tons of articles, videos. Again, all this value and information gathering that we're doing internally is all in there, including, tools that could be useful to investors.
That's great. No, Scott, again, like I mentioned a few times today, I love what you guys are doing. It's definitely serving a need in the marketplace. It's very unique. And I'm interested to see what you guys do.
I appreciate that. Yeah. Thanks so much for the good words.
So again, thank you so much for your time today, Scott. And to our listeners, if you're seeing value in what we're doing, just go onto iTunes, give us a 5-star rating. Also, please tell 5 others about our show. Everyone, this is Scott Choppin with the Urban Pacific Group. I'm Jeremy with the Real Estate Investor MBA. Take care. Cheers.